Thank you, Michael, because one of the things I've been talking to the CEDA crew about is how we can use our events more to give people things to think about when they leave, and to kind of guide them on what they might do when they leave a CEDA event. And thank you, Michael, you've done that. Everyone go and ask for a pay rise. But that's not CEDA endorsed, of course, that's CBA endorsed.
Reserve Bank endorsed.
Okay, so if you concluded by saying that you think the gloom's overdone. I am going to put this into perspective. Last year when Michael spoke, basically what he said was put the champagne on ice because we're going to be popping the corks later on in the year. It doesn't quite feel like that's your sentiment if I look at some of your charts. And I think at the Brisbane EPO, I said it kind of feels like you're telling people to reach for the flat white this year. Maybe a little bit unfair in any number of senses. I should actually note that I used to be a forecaster as well, so I have tremendous sympathy for Michael. But you talked about, some of the risks being overdone. You pointed to some tentative signs around wages, around maybe housing turning. But when I talk to others in the market, it feels like the risks are still tilted to the downside. And one of the things that people are focusing on is the consumer and consumer sentiment. And so I'm just wondering if you might spend a few more minutes just talking a bit about where you think the potential upside risks are, and are there things that you think others are missing or putting too much emphasis on?
Well, I think one area to think about here where the upside might in fact be is in fact the global story. Now, when we talk about the global economy, what we really focus on in Australia's case, of course, is China. And the Chinese economy is slowed. There's absolutely no doubt about that. But I think a lot of people spent most of last year in denial because the common message we were getting was, well, the Chinese policymakers aren't going to do anything about it. They're focused on other issues, cleaning up the environment, fixing up imbalances in their financial system and the like. But towards the middle of last year and during the second half of last year, policymakers started to apply some stimulus. So the narrative then shifted, well, they're not going to do enough. It's not going to be a repeat of 2008 where they went really hard in stimulating the Chinese economy, which certainly helped countries like Australia avoid recession back then. But there is now a lot of policy stimulus in place in China, with more to come, we think, in the first half of this year. And it is enough, we think, to remove a lot of the downside risks to commodity prices. And in the end, it's the ups and downs in commodity prices that really drive income in Australia. So if we get a more stable picture rather than the falls, the kind of consensus view for this year, then you change a lot of the dynamics. And one of the reasons why the budget deficit is shrinking at the pace it is because of that additional revenue that's coming through right now. And that's before we even kind of factor into the calculations where the iron ore price is sitting right now at close to $90 a tonne. Now, I know it's there for other reasons rather than Chinese demand as such, but that difference in the sort of prices that were expected and what we're actually getting, well, there's enough there for an extra $3 billion worth of government revenue, we think. So the government's flush with cash, which means they can do things. And to the extent that households are missing out in this income story, then tax cuts are the way to go on that front. So certainly bringing forward some of those bigger tax cuts that are out somewhere in the next couple of years will be a very good idea. We think from a policy perspective, and we'll be directly targeting where the big domestic risk issue lies.
So I'm going to turn to the audience for questions. You know the drill from the first session. Raise your hand, a microphone will come to you, and introduce yourselves and where you're from. But while you're all shooting your hands to the air, I am going to put you on the spot, Michael. You said that the central bank governor, Reserve Bank governor, is could go one way, could go the other way. Are interest rates going up or down?
Well, good question. No, if I look at our forecasts, what they actually show for Australia over the next couple of years in terms of the numbers, growth running around that 2.75% level that I mentioned was sort of trend or normal growth for Australia. That looks to be enough to say the unemployment will slowly move lower from here, and that wages growth will continue to slowly pick up, and slowly inflation will return back to the Reserve Bank's target range, that 2 to 3% band they want to get into. So all of those things would say to you that the next move in interest rates is going to be up. But I've used the word slowly a lot of times there. Other central banks use the words like patient quite frequently. We saw the Federal Reserve in their policy discussion earlier this week use the word patient 13 times in their press release. So it tells you something about the global theme for central banks here. So I'm happy to say the next move is up. I'm willing to say that's still a long way off, and in our forecasts we have it in there at the end of 2020. So almost 2 years from where we are today, and that's after more than 2 years where nothing has happened anyway. At that point, we'll be taking bets whether Phil Lowe can get through his entire term as governor without changing interest rates at all, and it will certainly be a real possibility.
Now, I have to warn you, if you do not ask questions and start now, Michael and I are just going to sit here all morning chatting because we can do that. So, have I got any questions from the audience? Okay, well, I'm going to give you stuff to think about, hopefully. Michael, one of the things that I have great sympathy for you as a forecaster at the moment is, you know, we all run our models based on history and data trends, and really, gosh, the last 10 years, that's just been turned on its head. And you're just talking about interest rates, and this benign interest rate environment is not something that economic models in the previous decades would ever have forecast, much less the sorts of numbers that we're putting on interest rates now consistently, or for that matter, unemployment, you know, consistently. So it is a different world, and one of the things at the moment that is vastly different is just the geopolitical uncertainty. How do you, as a person who has to sort of opine on the future, and be accountable for it, unfortunately, in public. Yeah, how do you factor that into your models, and how are you sitting down with the teams and talking about that, and what sort of confidence bands do you put around, you know, outcomes these days?
Yeah, well, economists have had to learn how to spell a new word, geopolitics, because it has become a very important driver. And we heard the Shadow Treasurer actually refer to, I think, how the issues here are playing out. And a lot of households in particular, and not just in Australia, but around the world, their budgets are under pressure from weak income growth, high levels of debt in other countries as well as Australia, and from just rising prices in terms of a lot of those essentials that you actually have to spend money on. And when you speak to groups like that and tell them in a sense they've never had it so good, because all the benefits from economic reform and so on that are coming through, not surprisingly, most of them won't believe you. So they've stopped listening to politicians in a sense. They've stopped listening to economists as well when we tell them this part of the story. So what you've actually got is, I think, a significant group in a lot of countries of people who feel like they haven't really benefited at all from all the kind of hard work that they put in themselves, and all the sort of difficult policy decisions that they've had to deal with as well. And there you have an environment that's ripe for populism. And in fact, the experts look at these things that tell you the way it works is, well, you have a big disaffected group in your community. So you come out and side with that group against the elites who are causing all of the pain and forcing through these changes. You manufacture a crisis or use a crisis to some extent. So let's build a wall, for example, there. Yes, there's a large enough percentage of the population that sees a way out of their current predicament in that. And as I say, populism, then you've got environment ripe for all these geopolitical uncertainties that we're seeing. I mean, the good news here is that populists are elected to fix a problem, so the first thing they do is to stimulate the economy. And, of course, the reason the US economy has done remarkably well over the last few years is because of that stimulus that's been put in place. And we can argue that was probably the right thing to do in terms of the US requirements at the time. But, of course, these issues are playing out around the world. So while we tend to focus on trade wars and things like that right now, you've still got Italy bubbling away in the background. The sharp end of the Brexit process is obviously very, very close at the moment. There's European elections coming up in May of this year. Our own elections probably in May as well, where the expectations from the experts are that we'll see those kind of minor parties, if you like, probably gain an increasing share of the vote again, as we've been seeing over the last few elections.
So we've got a A question over here, thank you.
Michael and probably also Melinda, Doug Ferguson, KPMG. Michael, I thought one of the points that you had on your slide was very interesting for both the consumer and also the election cycle, that consumers or Australians are desensitised to good news and increasingly more reactive to bad news. This seems like a major impediment for growth and going forward. I'm just interested in both your comments on that, how we get people thinking more constructively.
Yes, I mean, I think a lot of the pressures on households have been in place for quite a while now. So households are obviously very well aware of the amount of debt they have on their balance sheet. They do get concerned about the occasional story about higher interest rates that was coming through last year at least, even if we're now discussing the possibility of rate cuts this year. Despite a fantastic labour market, a lot of people still worry about their job security. And they see their pressures or their budgets under pressure from what I like to call the pain spend. So there's all that money you've got to spend on things you don't enjoy. And again, I think the Shadow Treasurer listed some of these, school fees, health insurance charges, and the like. And overlaying the top of that is this weak wages growth. It's very hard to change any of those things, and the only kind of lever you've got really is wages. Obviously, higher incomes would alleviate some of the pressures that households see, and it's why people like the Governor of the Reserve Bank do talk a lot now about the need for wages growth to pick up. And while economists talk endlessly about monetary policy and fiscal policy, the reality is we should be speaking a lot more about wages policy as well, as I think the only kind of lever that we have to try and influence the problem there right now.
Yeah, I think the only thing that I would add is that I think one of the things we've learned over the last couple of years is that you can get a little bit complacent looking at some of the fantastic headline numbers that we've seen in Australia. So, yep, real GDP growth has been great. The 27 years of uninterrupted economic growth, yes. A lot of that's been driven by population growth. The Shadow Treasurer spoke about productivity growth. It has been missing in action. And that's translated to some pressures that we've seen households responding to that perhaps we haven't been quite as alert to as we ought to have. The cost of living pressures in particular, the underemployment trend. There are people who are looking for more work in part to respond to the cost of living pressures. And I don't know the recent statistics here. I know NAB used to put out some information around people's financial resilience and buffers at a household level. But I was reminded of the importance of this earlier this week when I was at an event that Joe Hockey spoke to. And he quoted some numbers out of the US where he said at the time that Trump was elected, 70% of households in the US had no more than $1,000 of household savings as a buffer. And I suspect the numbers here are not that extreme, but nonetheless, I think there is an issue there. And so I think the challenge for all of us who comment on economic policy and economic data all the time is to actually just remind ourselves to take a step back and actually look beneath it and understand how that's translating to households and how that then translates to their engagement with an economic reform agenda, which is certainly something CEDA's trying to focus on. We've got a question here.
Thank you, Michael. Peter Actistrat, New South Wales Productivity Commissioner. Thank you for that overview. I'd like to ask a question about the dollar, the Australian dollar. Now, if we can quarantine the effect of interest rates, I mean, some say interest rates will go up, some say they'll go down, and I know you're suggesting the long term they might edge upwards. If we leave out the issue of interest rates, what are the other fundamentals affecting the dollar, and do you think it will fall or go up?
Well, as an economist, I'd say the biggest influence on the Aussie dollar is commodity prices. We're widely seen in financial markets as a commodity currency, so anything that's kind of good news from a commodity perspective, you tend to see the currency go up. In the last year or two, the currency's obviously gone down, and that's partly because of those negative views about the outlook for China and what that was going to mean for commodity demand. So we've fell down on the back of that. But the other thing I'd say about the Australian dollar is depending on which measure you want to look at, it's probably the fourth most traded currency in the world. So sitting above us is the US dollar, the yen, the euro, and so on. And so whenever there are these events that are seen as negative for the global economy, and you're looking for a currency to sell, the first one that comes up on the list is the Aussie dollar. So we've become very responsive as well to kind of shifting views on risks in the global economy. And of course, at the moment, people are seeing plenty of downside risks there. So again, something that's impacting on Australia.
Question just here, thank you.
Michael, it's Damien Webb from First State Super. Thank you. Question around your analysis around the household and household lending. Thank you. I thought it was very interesting. Now that the Shadow Treasurer is, I think, left, the question on the impact of potentially negative gearing and the removal of that potentially, and just whether you guys have done any work on that and your views on that and the household and particularly lending.
Yeah, well, I think a lot of the focus on negative gearing is probably overdone. A lot of people have discovered they are in fact positively geared because interest rates have fallen in the last few years, of course. So I'm not sure focusing just on that part of the story is necessarily where you want the policy focus to be. If you're really interested in shifting investor appetite for housing, then it's the capital gains tax is the lever, because you're then changing the after-tax, after-deductions return that investors will get from investing in housing. So you can fiddle around with that if you really wanted to do things. You don't need to touch negative gearing, which I think brings the risk of other distortions. Our suspicion at the moment, or I should say my suspicion really, is that part of the reaction we're seeing in the housing market is as if those policy proposals are already in place and that they apply to everybody. So we've in a sense overreacted to the policy changes there. Do you want to make those sort of policy changes when prices are falling? Then I would say it's probably not a policy option that you want to put in place on day one. After any change in government. So and it's certainly an easier policy message to sell, I think, if prices are actually rising. So timing is going to be quite important, I think, when this policy is put into place.
I won't put you on the spot and say whether you think it's a good policy or not. We've probably got time for one more question, otherwise I will wrap up and give you a few extra minutes of networking time. I could go to my auctioneers thing and carry on the theme. Well, thank you, Michael. As always, a great contribution to CEDA's economic and political overview. I do like the fact that I think Michael's trying to present a really balanced view about where the risks are and looking for some of the positives at a time when perhaps people are looking very much the other way. If I can just put in a little bit of a plug, segue into some work that CEDA did last year. You know, we have had this fantastic run of economic growth. I think there is a real focus now on is that sustainable and how do we sustain that, and possibly a little bit of gloom and doom around that. One of the things that we've tried to do is to be realistic, yes, but also pragmatic, but optimistic. And to look back on Australia's record of economic development and to actually highlight that there are some really strong characteristics of how we've achieved this 27 years of economic growth. And as we look forward to talk about reform and in an election context this year, that one of the things that we shouldn't lose sight of is our capacity to actually address the big challenges before us. And we've done it before at times that looked far gloomier than they do now. And if we bring that spirit of realism but also optimism, we're certainly in the camp of thinking that we can continue to do it, and do it in a way that is characteristic of how we've done it in the past, based on a strong social compact and really benefiting from the global engagement that we have. So that was our Connecting People to Progress work. If you haven't had a look at it, please do so. But join me now in thanking Michael for his contribution once again to CEDA's EPO.